And here, this is the most important formula for portfolio. So CAPM returns equals. Will you repeat the question? Yes, I'll repeat that same question, yes. Because they want us to repeat. Thank you very much. So we have CAPM returns being equal to risk-free plus ERM minus risk-free multiplied by beta of the security. I've seen some students bringing the beta here. That is still good enough. That's still good enough. Good enough. Thank you very much. Now, ladies and gentlemen, how about arbitrage? Arbitrage pricing model. APM returns. First of all, what is arbitrage pricing model? What is arbitrage pricing model? What is arbitrage pricing model? Arbitrage pricing model. Morning or evening? Perhaps when I was greeting them, I said good morning. I'm not so sure. Oh, it should be 8 p.m. The free of charge class. We'll discuss about the free class on our WhatsApp, so you don't confuse issues. Let's discuss about the free class, tomorrow's free class tomorrow in our WhatsApp, please. So they're telling me, these students are very bright, that a arbitrage pricing model is a multiple. It's a multiple factor model. APM is a multiple factor model. Unlike CAPM, which is a single factor, a single risk, it assumes that you only have one risk, that is risk factor, that's CAPM, a single beta. Under APM, we shall be having multiple factors, or, ladies and gentlemen, we shall be having what we call multiple risk factors, multiple betas. And as such, for us to be able to get the APM returns, what do we have? I've not seen anybody writing the formula of APM returns. APM returns equals who? APM returns. APM returns. I'm waiting for APM returns. I'm waiting for APM returns. Okay, let me just remind you. To get the APM returns, ladies and gentlemen, we will always start to any return. We must always start with what we call risk-free. We must always start with risk-free. So once I have my risk-free, I will come inside here. Now talk of expected returns, given factor 1, first factor, minus risk-free, and then of course we have beta of factor 1. Beta of factor 1. I told you that APM is multiple factor, multiple risk factor model. Plus, we have in this case here ER2 minus RF multiplied by beta 2. And then at the end of the day, I'll come and say what their end of thinking capacity, etc. like that. APM. Thank you very much. So we are saying that ER1 is expected returns given factor 1. Expected returns given factor 1. And of course, B1 is beta factor, of factor 1. Beta of factor 1, it is. So here 2 like that. And then of course, RF will always stand out. And if you can remember in our normal classes, ladies and gentlemen, we say that whatever you are seeing in brackets here is representing what we call the premium. Whatever we see in brackets is called the premium. That amount which is over and above our risk-free rate is the premium. Now, ladies and gentlemen, I would want us to look at just some small example. An example here where they have given us risk factors. Example, risk factors, we have 3 of them. We have X1, X2, X3. And then we have the risk premiums. Examiner loves this. We have the risk premiums. What do we have here for risk premiums? Risk premiums, we have 5%. Then we have 7% here. Then we have 12%. 12%. And then we have the beta factors. Beta factors. We have the beta factors. Beta factor of x1 is 0.8. This is 0.2. And then we have x3. X3 beta factor is 1 exactly. Is 1 or talk of 1.2. 1.2. 1.2. 1.2. Right? Additional information. Additional information. Additional information. They have defined these factors for us. Like x1, they are telling us x1 is an energy index. Energy index. X1 is an energy index. Then we have x2. X2, ladies and gentlemen, is a market price index. 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 And then we have x3. X3 represents an exchange rate index. Exchange rate index. Exchange rate index. Exchange rate index. And then lastly, down here, they have given us the risk-free rate of return. No problem. Down here, they have given us what we call RF. And the RF they're giving us, ladies and gentlemen, is 8%. RF is 8%. RF is 8%. RF is 8%. And then they want us to do very simple things. They want us, ladies and gentlemen, to give them the CAPM returns. That's number one. And then number two, the APM returns. CAPM returns and the APM returns. CAPM returns and the APM returns. So what do we have here? CAPM returns and the APM. CAPM is capital assets pricing model. APM is a arbitrage pricing model. You said, they've seen. Your examiner asking you the differences between the two. The biggest difference is that CAPM is a single risk factor model, single beta, one beta. Whereas APM arbitrage is a multiple risk factor model, multiple risk factor model, multiple risk factor model. Kamera ako sawa leo. Pia mtu wa kamera, cheza kama wewe please. Very good. Thank you. So before we talk about the cameraman, I'll also ask him to come here in front of his camera. So before we talk about him, could you kindly do this question for me? The CAPM returns, you guys are experts. You guys are experts. You guys are experts. So is there somebody who has been able, ladies and gentlemen, to give us? So I'm being given a figure there, CAPM returns from Dan is 9.4%. Because according to Dan, Dan has known first of all the formula. And our CAPM return should start with RF. Into, we have ERM, minus in this case here RF, multiplied by beta of the security. And then Dan came and knew very well that under CAPM, we are only being affected by one factor. So here we have a single factor, and that factor must be a market factor. The factor must be a market, what here? A market factor. And the only market factor that we have here is market price index, X2. So under CAPM, there is no way you can talk about X1. There's no way you can talk about X2. So under CAPM, ladies and gentlemen, we are only talking about, under CAPM, we are only talking about the only factor which is reflective of the market prices of shares. So in this case here, we are saying that under CAPM, we shall use we shall use at AFM, we shall use X2, which is the market factor, factor, X2, market price factor, market price index. So ladies and gentlemen, if that is truthful, then my AFM returns will be equal to risk-free that I already have, which is 8%. Plus, we have whatever they have given us here, we're not going to subtract at all. Whatever they have given us here is already subtracted. They have given us what we call the risk premium. So in this case here, I will come and pick the risk premium the way it is, multiplied by, remember I'm working with X2 for AFM. I'm working with X2 for AFM, multiplied by 0.2 what here, somebody? 0.2 like that, and then you give us an answer. You give us an answer. What are we able to get, somebody there? So from 2, 1, whatever, I'm being given 9.4. Thank you very much. 9.4 is correct because this is 1.4 like that. Now from there, ladies and gentlemen, please go ahead and give me the APM returns. Go ahead and give me the APM returns. Today is your lesson. Today is your lesson. Give me the APM returns. Give me the APM returns. APM returns. So I'm giving you 1 minute. APM returns equals. Is there anybody who has been able to give us that answer? Returns. APM returns, I can see 27.8, 27.8, 27.9 from Christine, Susan, 27. There is a 39, Reshare the formula for APM. APM returns we have risk-free plus, we have expected returns of factor 1 minus risk-free multiplied by beta of factor 1 plus, we have expected returns of factor 2 minus risk-free multiplied by beta 2, etc. like that, etc, etc, etc. So ladies and gentlemen, we have our risk-free in this question that we have copied here is 8%. For APM, we are taking into consideration all factors because the APM is a multi-factor model. It's a multi-factor model. So we have 8% into here, factor 1. They have given us again the premium. I always get students who take like now this 5% minus again 8. No, when it's premium, it means over and above, over and above. So then this one here will be 8% plus. We have for factor 1, it's 5% multiplied by beta 1, which is 0.8. Plus, we have a factor 2 whose premium is 7% multiplied by beta 2. Beta 2, which is what here, somebody? 0.2. Plus, if my cameraman can see me all the way up to here, 12% times 1.2. So please give us an answer. Make sure you know how to use your body mass very well. Use your body mass very well. If I use my body mass very well, 8 plus 5 times 0.8 plus 7 times 0.2 plus 12 times 0.2, 1.2 I mean. So at the end of the day, I'm getting 27.8% as the APM returns. Now let me ask you a question. Did you expect really CAPM and the APM models to give you the same answers? Will they give you the same answers? CAPM and the APM, will they give you the same answers? No, they can't. Then that calls for us to discuss about the differences between these two models here. What are the major differences between CAPM and Apm? Somebody talk to us tonight. Differences between CAPM and Apm. I want to hear 4 differences from you. 4 differences between CAPM and APM. Yeah, like I can see some student who has really given us a good. So from Maxi, CAPM is a single factor model while APM is multi-factor. True. So in this case here, number 1, CAPM is single factor. APM, I'm being told in this case is a multiple factor model. You see, multiple factor. That's point number 1. Point number 2. From Christine, yes. Ladies and gentlemen, CAPM is purely for a single security. CAPM is purely for a single security, but APM can be extended because of its ability to take up more issues. APM in this case here can be extended to take up multiple securities or many securities, yes. You can have like security of a company Y, security of company Z, and the company E, being like your factors like that. So APM can be extended to capture many types of shares from many companies, right? From Emma says CAPM assumes normality, while APM do not assume normality. Very good. Who taught you these things? Number 3, ladies and gentlemen, CAPM ile kitu ya ugali ya Mluya, ile normal. So CAPM assumes a normal distribution, can only work if, for example, the share prices being given are clustered around some expectation. That we have a peak, like that. So it assumes normality. APM does not assume normality. It can work in this case here for a highly peaked distribution, skewed distribution. So APM is quite flexible. It doesn't assume normality. It doesn't assume normality. It doesn't assume normal distributions. Any answer? I'm only getting these answers from one student We have CAPM uses the utility curve to determine the utility of investors. I've understood what that must be a student who is really reading. What this student is telling us, ladies and gentlemen, is that CAPM must use the market what year returns. So CAPM needs, ladies and gentlemen, CAPM needs us to identify the market portfolio. To identify the market portfolio. And how do we identify the market portfolio? Remember, to identify the market portfolio, we must make use of what are the utility curves. So it makes use of CAPM must make use of utility curves. Util curves, which measures satisfaction. CAPM must make use of utility curves, whereas APM may not, or rather may not need the market. It can work without the market portfolio. And therefore, APM does not need what here, the concept of utility curves, because under APM, we don't need the market portfolio. We don't need the market portfolio. We don't need the market portfolio. Any other difference? No, Virginia, no. Both models here, because they make use of betas, they assume that investors are what here risk averse. Actually, the main concept of these particular models under portfolio CAPM is about risk diversification, is about risk minimization. There is one only point you guys are forgetting. There is need for a well-diversified portfolio. That point is similar to the one this student of utility spoke about. Because under CAPM, there's no way you can get CAPM premiums without the market portfolio. The market portfolio has to be there. The market portfolio has to be there. The market portfolio has to be there. Only one thing that you guys are forgetting is number five, because these guys can't give you more than 8 marks for this. Number 5, ladies and gentlemen, is that the CAPM returns are for a single period per annum. CAPM returns are for a single period, whereas APM returns here can go for a span of more than a year. So the normal talk of APM being a multi-period model. APM being a multi-period model, while CAPM is a single period model. Thank you very much. Now, ladies and gentlemen, something that I would want to see whether you guys really know, which is quite common in your exams. What are the key assumptions of CAPM? The key assumptions of CAPM. There are very many, there are over 20. But I want you to give me the key, like 4 of them. Key assumptions of CAPM. Key assumptions of CAPM, I'm waiting to read. Key assumptions of CAPM. Key assumptions of CAPM, I'm just waiting to read. Investors are risk averse. Number 1, investors are risk averse. Investors are risk averse. How do you get to know this? Remember, we said we've got 2 types of risks. So these risks, remember, we have what we call a systematic risk, and then we have the systematic risk. Down here. So for portfolio management, under CAPM, ladies and gentlemen, we are assuming that these unsystematic risks have been diversified. They have been sold outside there, ladies and gentlemen. We are assuming, ladies and gentlemen, that we are under what here? The systematic risk alone. Under the systematic risk alone. So investors are purely those investors who fear risks 100%. I like that. That'll give you a mark. Number 2, what do we have there? You could read for me. But before the ones of inflation, I want the key ones. Before perfect markets, I want the key assumptions. Those are correct, but they are key assumptions I'm looking at. No transaction cost, very good, but there are key assumptions which I'm looking at. Those are secondary. Nice, but secondary.
Expectations of investors are homogeneous.
Very good, expectations of investors are homogeneous, but that is still secondary. Secondary. Ladies and gentlemen, remember we have the CAPM equation. CAPM returns equals who? Risk-free into ERM minus risk-free into beta of a security. So the first assumption you have given me is as regards this beta. Because of the risk factor, risk factors, risk has to be minimized, and therefore you are assuming that these people are what your risk averse. There is another one here, number 2, that the risk-free rate of return. Risk-free rate of return, risk-free rate of return is known, risk-free rate of return is known, and assumed to remain constant. And assumed to remain constant. It has never been constant. This risk-free rate of return you always get depending on how much the government wants. If the government wants quite a lot from the market, they'll offer high risk-free rate of return. It is never constant, but we know that in theory, for us to be able to have our model working, we must assume that this risk-free rate of return is known. You'll get some books saying that investors can borrow, all investors can borrow at the risk-free rate of return. All investors can borrow at the risk-free rate of return. That is it. Number 3, from this equation, we will normally get the key assumptions. Number 3, we are saying that a well-diversified market portfolio exists. A well-diversified market portfolio exists. A well-diversified market portfolio exists. Which is also a lie, which can only exist in theory. We know, ladies and gentlemen, that in practice, it's not possible to have a basket of shares whose prices will always be up there. Blue chip companies can never exist. Look at a company like Kenya Airways. Just the other day, Kenya Airways was a pride of Africa. Right now, in terms of the losses they are making, like right now during this corona, these guys have got no strategy at all. Every other thing that they have is grounded. They're going to make losses up to 100 billion. So it's no longer a pride of Africa. Look at companies like, for example, Uchumi. When Uchumi used to be Uchumi, it used to be quite big. But right now, nowhere. Right now, nowhere. So things change. But you're saying that for us to be able to have a working model, then we must assume that we have got, ladies and gentlemen, an existing market portfolio. An existing market portfolio. An existing market portfolio. Any other key assumptions, ladies and gentlemen, that you guys can talk about? Returns are normally distributed. That is a key assumption. Returns are normally distributed. And it's because of this normal distribution, that they normally prefer making use of the expected returns, like now your expected returns. I mean, if they were not normally distributed, whatever returns you could be using as expected returns will not make any sense. Now, after you've written these keywords, if they want more, that is when now you bring in the issue of what your no transaction costs, right? Markets being what your perfect. Remember in AFM, especially if they ask about a model, an assumption, or rather assumptions of a model that you're not so much acquitted of, what you need to do is simply to give them those array of assumptions. Markets are perfect, no transaction cost, no taxes, etc. Now, if you allow me, ladies and gentlemen, I'll go to what we call portfolio performance measures. Portfolio performance measures. And I'll only work with the ones which are highly examinable. And I would want to hear whether it's a student of ours who is able to remember those models. Please list those models for us. I see somebody called Nelly saying Sharps. We have Jensen Sharps, trainer. And then we have from Christine, appraisal, performance measure. Very good. So we have Sharps. That's number one. So measuring, ladies and gentlemen, our performance using Sharps model. Who is able to remember the formula of getting the Sharps coefficient? Sharps coefficient, kindly try to put that formula down. Sharps coefficient equals who? Sharps coefficient equals who? I'm waiting to hear you guys talking about the Sharps coefficient formula. So we have from RK, R bar minus RF all over beta J. Beta J, no, but you've really tried. No, but you've really tried. Waiting to get some answer from another student. What do we have there? This gentleman has been able to correct all over standard deviation. Thank you very much, Josephine. What they are telling us, ladies and gentlemen, for us to be able to get Sharp's coefficient of any security, call it S, call it J. What you need to do is to get its premium, RJ minus RF. And then at the end of the day, what do? You will come straight away, ladies and gentlemen, you will come straight away and divide this by standard deviation. Because Sharp's standard deviation. Sharp's makes use of standard what here? Deviation as a base of giving us the Sharp's coefficient. SC stands for Sharp's coefficient. And then number two, they spoke about the trainer's model. The trainer's model, where we have the TC, trainer's coefficient. Again, we shall talk about RJ, it could be RS. RJ minus risk-free. All over, this time around trainers makes use of what here? Beta J. Makes use of beta J. Beta of a security. So trainer's model uses beta of a security, makes use of beta of a security. And then, ladies and gentlemen, number three, we have the Jensen's alpha value. Jensen's alpha value model. The Jensen's alpha value model. Could you kindly try giving us this formula of Jensen's? What does RJ? Thank you very much. RJ, these are returns of a particular security, like returns of Safaricom shares. Returns. And then RF stands for risk-free. Risk-free. Very good, Langata. Oh, many of them are asking, but I've answered now RJ. I've answered what RJ stands for. From Josephine, we have, thank you very much. Josephine has remembered very well something to do with this alpha. This alpha, ladies and gentlemen, to get this alpha, what do we have here? To get alpha, we have already counted this alpha. To get alpha of any security, we will simply look for the expected return of that security minus the CAPM returns of the same, could be K, CAPM RJ, or CAPM RS, etc. Very good. Now from there we have what we call the appraisal ratio. Number 4, appraisal ratio or information ratio formula. Let's see whether there is anybody who will be able to remember this appraisal ratio formula. Appraisal ratio formula. appraisal ratio formula. It's the easiest. Appraisal ratio formula equals what? Appraisal ratio formula, alpha all over and systematic risk. Thank you very much. Thank you very much. Alpha all over and systematic risk. Or better still, we can talk about RJ minus R from the benchmark. R from the benchmark. This could be the market, etc. So in terms of the benchmark security, all over what this gentleman is calling the non-systematic risk factor. All over the non-systematic risk factor. All over the non-systematic risk factor. So what we could do, we could go straight away to this question that we had done in the normal class. But now we do only for one security. We do for one security very fast, just for purpose of reminding ourselves what we did. If you go to your portfolio, yeah, you'll be able to see. There are not very many questions over this area, but it's an area you can't ignore. If you have your past paper, November 2015, question number 2. November 2015, question number 2. November 2015, question number 2. November 2015, all over. November 2015, I mean, part B. D for dog. November 2015, question number 2, dog. Question number 2, dog. Are we there? Board not clear. So you're looking at November 2015. Question number 2. November 2015, question number 2. November 2015, question number 2. So question number 2, dog. The following information relates to the portfolio's P and N. Assume that the risk-free rate is 6% and the average market return is 15%. They want us, number 1, to give them the Sharpe's performance measure for P. I only want to do for 1. So Sharpe's performance measure for P. Could you kindly help me get that? Oh, iko sawa eh? Hii njenga leo ndio uko na network mbaya basi. Na tukiguza tutakuwa tumefanya makosa sababu cameraman hata kwa amecheza kama yeye. So for D, what do we have there for D? For P, I mean. So Sharps makes use of what here? Sharps makes use of standard deviation. So Sharps uses standard deviation. Uses standard deviation. And if that is the case, ladies and gentlemen, then Sharpe's coefficient will be equal to returns of the security J minus risk-free all over the standard deviation of J, security J. So that the Sharpe's coefficient for P, what do we have there? Sharpe's coefficient for P, ladies and gentlemen, at the end of the day, are you able to see the returns of P? Are you able to see the returns of P? Returns of P, yes. They have given us the average returns of P as 35%. So we have there, you can decide to ignore the percentages, 35 minus the risk-free. What do we have there as risk-free? The risk-free there is 6, the one given before required. All over the standard deviation of J. Standard deviation of J has been given, of P has been given there as 42. So could you kindly give me this answer very fast? Kindly give me this answer very fast. I can see students saying it's 0.69. Thank you very much. 0.69. So later on, you'll be able to compute the one, this is the one of P. Later on, you should be able to compute the one of N. And of course, in terms of portfolio performance, the higher the Sharpe's coefficient, the better the performance of a given security. The higher the Sharpe's, the better. So that is P, Sharpe's coefficient for P. How about in this case, a trainer for P? Go for trainer for P. Please go for trainers for P. What do we have there for trainers for P? Trainers for P. What I need to know is that trainers makes use of what here, beta. So trainers model, that's number 2. For security P again, number 2. So trainers, what do we have there? Trainers coefficient is returns of the security itself. Could be the actual or the average or expected. So RJ minus again risk-free divided by beta divided by beta of that security J, like that. Now, ladies and gentlemen, then very fast, what I need to do here is to come and look for P. I can see the return of P is 35 minus the risk-free. The risk-free, ladies and gentlemen, has been given down there as 6. All over beta of J, which is 1.25 like that. So please give us this answer. What answer are they able to get there? 23.2, thank you very much. And I'm so sure most of you will be able to get later the one of N, trainers. Again, trainers, they have the trainers coefficient, the superior the performance is. That is trainers. From there we go to number 3, Jensen's. Number 3, Jensen's, ladies and gentlemen. Jensen's, ladies and gentlemen. First of all, you have to give us the CAPM returns. That is step number 1. There's no way you can get Jensen's without the CAPM returns. So first, give us the CAPM returns. First, give us the CAPM returns. So CAPM returns, what do we have there? CAPM returns, I know the formula. We have risk-free plus we have the expected returns of the market factor. Remember here, it's about market factor minus risk-free. And then outside here, we have beta of the security. So CAPM returns risk-free for P. I'm working only for P continuously. The risk-free is 6. The returns of the market, these people must have given us the returns of the market somewhere before required. When they give us a risk-free is 6. You'll be able to see the average market return is 15. So we have here plus 15 minus 6 multiplied by the beta of the security. Beta of this security, P, is 1.25. So could you kindly give us this answer? They're getting a 17.25. Which question? It's November 2015, question number 2, dog. November 2015, question number 2, dog. So most of them are getting 17.25, I'm being given a figure of 17.25. Thank you very much. Thank you very much. Now, after that, ladies and gentlemen, now we'll be able to give you the Jensen's alpha value. So the alpha of any security S will be equal to the expected returns of that security, could be J or whatever. minus now the CAPM returns. Minus the CAPM returns. So we have ERS minus the CAPM returns. So ERS, what do we have there? ERS. ERS is expected returns. That is the same as what your average returns. Could be even actual returns, doesn't matter. So the average return I'm being given a period of 35 minus the CAPM returns you guys have gotten just 17.25. So please give us an answer. Give us an answer. What do we have there? 17.75. So if it is 17.75, ladies and gentlemen, we simply need to come and tell these people that this security is super efficient. Remember under Jensen's, super efficient. The security is super efficient. The security is super efficient. Thank you very much. Now the last one, they want us to still tackle the same problem using the appraisal ratio. Appraisal ratio for P. Appraisal ratio for P. Appraisal ratio for P. Appraisal ratio for P. So for P, what do we have there? Appraisal ratio. Appraisal ratio for P. Appraisal ratio for P. I want to see whether a student will be able to get this appraisal ratio correctly. Appraisal ratio correctly. Now, ladies and gentlemen, this appraisal ratio, the very best, remember you are appraising this particular security, you are appraising it vis-a-vis the benchmark. Vis-a-vis the benchmark. The best definition here of this appraisal is the one where you will come and give us the appraisal ratio as the expected return of security minus expected returns of the benchmark, which in most cases is what here? ERM. And then you'll come and divide this by what here? The norm, systematic risk. You divide this by the norm, systematic what here? Risk. Of course, I know you get some custom solutions written alpha. We normally provide both. But in terms of appraisal, we normally compare our security with a benchmark. We normally compare our security with a benchmark like that. Therefore, our appraisal ratio will be equal to the expected return, ladies and gentlemen, at the end of the day, what we have there. Expected return of P. You are given me a figure of 35 minus expected returns of the market. Expected returns of the market have been given down there, 15. Returns of the market, they have been given down there, 15. All over the non-systematic risk value. The non-systematic risk value for P, it's 18. It's 18. So somebody give us an answer. Somebody give us an answer. 1.1. And remember, for all these parameters, the higher the better. The one that posts a higher parameter, the better. The one that posts a higher parameter, the better. And then now during our break, it's important we take a break, 5 minutes break. I would expect some of you to be doing May 2017, question number 2. Question number 2, boy. May 2017, question number 2, boy. May 2017, question number 2, boy. May 2017, question number 2, boy. let's continue. Is there anybody who wants me to do that question really, or already you have done it? Anybody who would want me to do that question? Yeah, we do it. Okay, so I'll just go through it very fast, because I'm so sure I must be boring some students. So I'll go through it very fast. It's May 2017. May 2017. Question number 2, boy. 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 So it reads, the following information relates to the performance of 6 portfolios over a 7-year period. So we have portfolios PQ all the way to U. Then they have given us the market returns, and then we have the risk-free rate. So they want us to rank the performance of the above portfolios using Sharpe method. So Sharpe method, ladies and gentlemen, this is quite an easy one. Sharpe coefficient, simply take returns of that security minus risk-free. Sharpe's base is always the standard deviation, like that. So we have a Sharpe coefficient here for P. I'm able to see the average returns of P as 18.6 minus risk-free. Risk-free, what am I able to see there as risk-free? Down there after U, market return risk-free, I can see 9 divided by the standard deviation. The standard deviation of P, which is 27. You know the percentages we are working these things out. So could you kindly, ladies and gentlemen, give us this value very fast? Ladies and gentlemen, give us this value. What do we have there? 0.356 or 0.36? 356, thank you very much. And you'll go and do the same for all the others. Like if it is Q, I will see the return to me. The return to me from Q is 14.8. Minus, if I had gone for treasury bills, the risk-free return would have been 9. The difference is what we are calling the premium, which I have to come and weigh in with the standard deviation of Q. The standard deviation of Q, I can see it is 18. The standard deviation of Q, I can see it is 18. So you continue like that, and then of course in your ranking, we ought to know. In our ranking, ladies and gentlemen, the higher, the better. The higher, the better. So I hope the two that I've done is a good guide for everybody. And if you allow me, I'll straight away go to the trainers method and again show you how to get these trainers parameters for P and the Q. For P and the Q, instead of doing everything for P and the Q. So for P and the Q, what do we have there? For P and the Q. Trainers for P and the Q. So trainers for our case here. For our case, it's P and the Q. Remember trainers, ladies and gentlemen. Under trainers, we'll take the returns of a security given there. We subtract what here, somebody? Risk-free. Basically, we get the premium. But now this time around, we have to divide this by the beta factor of J. So divide this by the beta factor of J. Divided by the beta factor of J. So the trainer's coefficient at the end of the day, ladies and gentlemen, I need the betas. But this examiner never gave us betas. So we have to compute beta. And remember beta J, there are 2 formulas that we must always remember. Beta J, 2 formulas which are very, very important for beta J. Beta J will be obtained by us taking covariance between J and M divided by the standard deviation of the market square. Please copy down this, put this down. Very important. Very important. Sorry for that. The camera needed some fuel, eh? Camera needed some fuel. Sorry for that. Okay. So now we have to get beta J. And to get beta J, we are explaining here. To get beta J, ladies and gentlemen, there are these two formulas which are quite important. Beta J equals covariance between J and M divided by the standard deviation of the market done what here squared. How about beta J using the correlation coefficient approach? Using the correlation coefficient approach. Using the correlation coefficient approach, beta J will be equal to what, somebody here? Using the correlation coefficient approach, beta J will be equal to the correlation coefficient between, again, J and M. But this time round, I must multiply with the standard deviation of J all over the standard deviation of what here? The market. So these two formulas, whenever I'm going to any advanced FM class, they have to be with me. I have to remember them. Ladies and gentlemen, if that is the case, I will come here and compute beta first of all for our two securities. So give me beta of P. So what I need to do is to take the correlation coefficient of P and the market, which this examiner has given to us. The correlation coefficient, you can see the column there for correlation coefficient. Correlation coefficient with market returns for P, it's 0.81. So I'll take 0.81 there times the standard deviation of this security P, which is 27, all over the standard deviation of the market. The standard deviation of the market, this examiner is a tricky one. You're able to see market return. And the market return, I can see average return is 12%, and then standard deviation itself is 12%. So the standard deviation of the market is 12%. So now you get your calculator and give us an answer. Beta of portfolio P. What do we have there, somebody? What answer do we have there, somebody? Please help us. I'm being given a figure of 1.82. 1.82. Thank you very much, Noor. Really, I can see there. So from there, come and give us now beta. Having gotten beta for P, come and now plug it in here to get us the TC of P. TC of P. What do? You will take the returns of P. They could be actual or average. The returns of P that I'm able to see in this question, the average returns of P, I can see 18.6. So I have here 18.6 minus the risk-free. The risk-free has been given down there, which is 9. The risk-free has been given down there, which is 9. Come and divide this by the beta over P, which is 1.82, like that. So please give us an answer there. Give us an answer there. I can see from Dan 5.27. Thank you very much. 5.27. Now, could you kindly do me a favor? Give me TC for security Q. For security Q with your friend. Give us TC for security Q. So have they gotten the answer for, I can see most of them saying 5.95. I hope that is the correct answer for TC, trainer's coefficient of Q. And I want you to go and do that question, ladies and gentlemen, later, the whole of it. I just wanted to give you the way forward.